Welcome to Iron Financial, the only place dedicated to helping you forge a stronger portfolio. I'm your lead analyst.
And I'm your market skeptic.
Today, we are putting a company under the forge that has pulled off one of the most shocking transformations I have ever seen in the public markets, Sharplink, ticker SBET.
I've seen the charts, and shocking is one word for it. My question is, have they actually built a financial fortress, or is this just a house of cards waiting for the first gust of wind?
That's exactly the question we're here to answer. Let's start with the number that changes everything.
All right, look at this. Just take a second to absorb that number. At the end of 2025, Sharplink reported total assets of $2.4 billion. That's billion with a B. For all intents and purposes, this is the new foundation of the company, a balance sheet that puts it in a completely different league. It's a staggering figure.
A foundation built on what exactly?
A number that big appearing out of thin air demands some serious scrutiny. You know, for a company that was a complete ghost on my radar just a year ago, this figure isn't just staggering, it's deeply suspicious. Where in the world did it come from?
And to your point about it appearing out of thin air, well, here's the context that makes it all the more unbelievable. 1 year prior, their total assets were $2.6 million.
Million? With an M. Okay, let me get this straight. We're saying they went from a company you could basically buy with a loose change in your couch to a multi-billion-dollar entity in 12 months. That's not a reinvention. That sounds like a magic trick. This is the kind of stuff that makes the hair on my neck stand up. Something doesn't add up.
Okay, hold on. Let's just stop right there for a second. How is that even possible? A nearly 1,000-fold increase in assets in a single year? My alarm bells are ringing off the hook right now. Is this real, tangible value, or is it just clever financial engineering? Some accounting trickery designed to pump the stock for a quick exit? We need to drill down, and I mean really drill down, into how they pulled this off. Because for the average investor looking at this, it's either the opportunity of a lifetime or a massive, massive red flag. So what's the real story here?
That is absolutely the right question to ask. And to understand the new structure, you first have to understand the old one, and just how badly it was failing. It was a complete wreck.
You see, before this massive transformation, Sharplink, which was then known as Sharplink Gaming, was a tiny, small-cap, struggling affiliate marketing company in the online gaming space. Think of a business that tries to drive internet traffic to sportsbooks and online casinos. It's a really tough, low-margin, capital-intensive business that was, to put it bluntly, bleeding out cash. They were a million miles away from being any kind of financial powerhouse. This wasn't a growth story. It was a survival story. And frankly, they were losing.
And look, don't just take my word for it. This is a direct quote from their own 2024 10K filing. The company's own auditor, Cherry Beckert, issued what's known in the industry as a going concern warning.
Let me translate that for everyone at home. A going concern warning is the financial equivalent of a doctor telling the family the patient is on life support and may not make it through the night. It means the auditors themselves had substantial doubt the company could even survive another year. They were burning cash, they had recurring losses, and they were right on the brink of complete and total failure.
Exactly. This wasn't a stable foundation, it was crumbling into dust before their very eyes.
So, with their backs completely against the wall, management had to make a choice. Either fade into obscurity and bankruptcy, or make a gigantic bet-the-farm pivot. They chose the pivot. Starting in the spring of 2024, they began a complete strategic reassessment. By June of 2025, they made their move, formally launching a strategy centered entirely on acquiring Ether, the native token of the Ethereum blockchain, as their primary treasury asset. This all culminated in them officially dropping gaming from their name in early 2026 to reflect their new identity. They weren't just changing their business, they were changing their entire corporate DNA.
But why ETH? I mean, a failing online gaming company suddenly pivots to crypto? That sounds less like a coherent strategy and more like a desperate Hail Mary pass into the end zone with 2 seconds on the clock. Are they just chasing the flavor of the month, hoping to catch a hype wave and save their own skins? The logic, according to them, was to fill a very specific gap in the market. Their stated goal was to become a regulated, publicly traded proxy for ETH. Think about it. Large institutions, pension funds, family offices, they often have mandates that prevent them from buying digital assets directly from an exchange. It's an operational and regulatory nightmare for them. So Sharplink's strategy was to become the vehicle for that exposure, a clean, SEC reporting company that does all the heavy lifting of acquiring, securing, and managing the ETH. In essence, they are building a bridge for big money to cross into the Ethereum ecosystem. And this slide right here brilliantly illustrates the result of that pivot. This is the new foundation of Sharplink, in black and white. Just look at the lines. Cash went from a meager $1.4 million to over $28 million. Crypto assets, of course, went from 0 to 2.4 times billion. And just as important, look at the other side of the ledger. Total liabilities are minuscule, just under $13 million against $2.4 billion in assets. This translates directly into a massive increase in stockholders' equity from $2 million to $2.4 billion. This is a balance sheet that has been completely reforged from the ground up. Okay, I see the numbers, but you can't just wish assets into existence. Where did $2.4 billion in crypto come from? They didn't just find it under a mattress. With only $1.4 million in cash to start the year, how in the world did they finance an acquisition of that magnitude? That's the crucial point. They went to the capital markets. They executed a series of offerings and raised approximately $3.2 billion in fresh capital during 2025. They used that capital to acquire a war chest of nearly 870,000 ETH. And look who gave them that capital. Institutional ownership skyrocketed from just 6% to 46%. This was Wall Street buying their story, hook, line, and sinker. And the key strength here, the bedrock of this whole thing, is that they did this without taking on any long-term debt. This isn't a leveraged bet. It's a fully funded equity position. They built a fortress.
A fortress balance sheet is one thing, but a business is supposed to be profitable. That's the whole point, right? After all this maneuvering, raising billions, and buying all this crypto, did they actually make any money? What does the bottom line look like? No. And this is where the story gets very complicated. For the full year of 2025, they reported a net loss of $734.6 million. $734 million? That's not complicated. That's catastrophic. It looks like they built this massive structure just to have it lose $750 million in its very first year of operation. How is that possibly a success?
A $735 million loss. I mean, how do you possibly defend that? That's not a rounding error. That's a gaping structural hole in the side of the ship. It suggests the entire strategy is a total failure from the get-go. Okay, this is where we have to pause and understand the critical difference between an accounting loss and a real cash loss. Because of U.S. generally accepted accounting principles, or GAAP, companies holding crypto assets have to mark them to their market value. An unrealized loss is a paper loss. If the price of ETH goes down during a reporting period, they must record a loss on their income statement even if they haven't sold a single token. It is not a cash outflow. It's a non-cash accounting rule that creates huge volatility in the reported bottom line and absolutely spooks investors who don't look deeper. So let's break it down. Let's look at the anatomy of this loss. As this chart clearly shows, the entire reported loss is composed of these non-cash charges. They had a $616 million unrealized loss for marking their ETH to a lower market price. They also took a $140 million impairment charge, another non-cash hit related to some of their holdings. When you add those two together, you get over $756 million in non-cash charges. In fact, they actually had a realized gain of $55 million from some trading activity. So, the crucial point is, the entire operating loss, and then some, is attributable to these accounting rules, not from the business burning through its cash. And while the bottom line was hit by those paper losses, the top line, the revenue, tells a very different and much stronger story. In 2024, they did about $3.7 million, all from their dying affiliate marketing business. In 2025, they generated over $28 million in total revenue. And where did that new revenue come from? Look at the top line. Over $25 million in new revenue from staking their ETH holdings. They went from zero to a multi-million-dollar high-margin revenue stream in less than a year. This shows the core strategy isn't just about passively holding an asset. It's about making that asset productive and generating real, recurring cash flow for shareholders. All right. I get the accounting nuance, the losses on paper, the new revenue's real. Fine, but this is still crypto we're talking about. We're talking about decentralized finance. This world is filled with landmines and black swans. So let's put this so-called fortress through a proper stress test. Forget the accounting for a minute and let's talk about the real-world dangers. What are the cracks in the armor? What does the company itself say are the biggest risks in its own SEC filings?
An excellent question. Let's dig into the risks they outline, starting with the most obvious one.
The first and most significant risk is pure market and asset volatility. At the end of the day, the company's value is overwhelmingly tied to the price of a single, highly volatile asset, ETH. If the price of Ether collapses, so does the value of their assets and their share price, regardless of their strategy. The entire crypto space is also subject to brutal industry-wide deleveraging events. Think exchange collapses or protocol failures that can trigger forced selling and massive price drops. And just look at their own stock's 52-week range, from $2.26 to $124.12. That is not for the faint of heart. This is a high beta play, and investors need to have a stomach of iron to hold it.
Right, and beyond the price, there are the operational and technical dangers. They aren't just holding ETH in some offline cold storage vault. As their filings state, they are actively using decentralized finance, or DeFi, and liquid staking protocols to generate that yield we just talked about. This introduces significant smart contract risk. A bug or an exploit in the code of one of these protocols could lead to a catastrophic and permanent loss of funds. We've seen it happen time and time again in this space. Blockchains are irreversible. There's no undo button for a hack or a simple human error. And while they have an in-house team, they still rely on third-party custodians and validators to help secure and stake nearly 1 million ETH. A failure at any one of those partners presents another vector of attack.
And finally, looming over all of this is the massive regulatory question mark. The rules for digital assets in the United States are still being written. They are developing, they are uncertain, and they are highly political. A future SEC ruling could classify ETH as a security, or new laws could be passed that fundamentally alter or even prohibit their staking activities. The entire business model is built on a regulatory landscape that is shifting sand. Operating as a public company in this environment is incredibly expensive and requires a huge amount of management's time and attention just to stay compliant with rules that could literally change tomorrow. This is a significant, unquantifiable risk.
So, after drilling down, here's the verdict. The bull case is clear. Sharplink has built a unique, publicly traded vehicle for institutional ETH exposure. They have a fortress balance sheet with virtually no debt, a clear stamp of approval from big money investors, and a smart strategy to not just hold ETH, but to make it productive and compound their holdings over time through staking. It's a pure-play, shareholder-aligned structure. But the bear case is just as compelling, and maybe more so. At its core, this is a concentrated bet on a single, notoriously volatile asset. It's wrapped in confusing accounting that produces these terrifying headline losses, which will always scare off a segment of the market. And the entire structure is completely exposed to the existential risks of the crypto world. DeFi hacks, protocol failures, and the looming threat of a regulatory crackdown that could change the entire game overnight. It's a potential trap for anyone ignoring those external dangers.
Now, despite those very real risks you just laid out, it's worth noting what Wall Street thinks. We have several respected analyst firms that have initiated coverage, and their outlook is decidedly bullish. JMP Securities has a $50 price target, Bernstein is at $24, Canaccord and Cantor are at $16 and $15 respectively. Now, with the stock currently trading in the single digits, these targets suggest a potential upside of 200% or even more. So, while the risks are significant, the professional analyst community clearly believes the potential reward is substantial enough to warrant a positive rating.
So that brings us to the final crucial question for you, the investor. You've seen the fortress and you've seen the cracks. Is this a structure built of solid iron, engineered to withstand the storms and deliver on that 200% plus potential upside that Wall Street sees? Or is it a fragile house of cards, destined to collapse the moment the next major crypto winter or regulatory hurricane hits?
The answer to that question will determine if Sharplink forges a new path for institutional crypto or becomes just another cautionary tale.
That's all the time we have. For Iron Financial, thanks for watching.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.